This week, we're speaking with a portfolio manager from New York who has a long history of helping people make better wealth decisions by taking into account what has gone on historically and finding ways to build more resilient portfolios to help you navigate challenging times. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, we're joined by Philip Toews, who is the lead portfolio manager of the Toews funds and the Agility Shares ETFs, as well as the co-founder of the Behavioral Investing Institute. He is also the author of The Behavioral Portfolio, Managing Portfolios and Investor Behavior in a Complex Economy, which is what we're going to be talking about today. Philip, welcome.
Thanks so much, John. Great to be here.
Tell us about the book. Why did you write it and what did you hope to accomplish with it?
Yeah, so we've been doing asset management for decades, and our specialty is trying to hedge against crisis markets. I recently got into behavioral finance because what we realized, John, was that investors and advisors had horrible timing of entry and exit into our stuff. So as an example, after the financial crisis, everyone wanted to buy our hedged equity solutions. And right before big downturns, people wanted to sell it. So we got into behavioral finance to do that. But as we got into the field, one of the things we realized was that despite the massive amount of literature on behavioral finance, despite the fact that you got some great minds at it, there were no prescriptions for exactly what to do about it. And I will say two key insights in the book, I think. And number one is that you can't start behavioral coaching without thinking about how the portfolio is built. That's a difference between a lot of the behavioral finance literature that's out there in this book, is that we say that if your starting place is a portfolio that could wreck investors or creates an unnecessary amount of stress or outright losses, that's not okay. So start with the portfolio. And then number two, behavioral coaching all needs to be done in advance of negative activities happening. So you front load it, and that's the way you have success. You can't react to stuff and then have it be effective in the field of behavioral coaching.
Okay, so a lot of what you say in the very beginning of the book is exactly that, how behavioral coaching is a big part of what financial advisors do or purport to do, hope to do in their practice with retail clients. But you also point out that the industry is not necessarily inclined toward rational decision-making. And I'm wondering if you can maybe explain a bit more about the interplay between the mindset of the financial services industry, the value proposition put forward by most financial advisors, and the psychology of investors and how those things play against each other.
Yeah, totally. I would guess that if you ask the average financial advisor, they would say something like, I get it. I understand the markets. I'm generally not too vulnerable to biases. And my investors maybe don't. And that's why they need me. And through my help, we're going to get this thing right. Not sure that's an accurate assessment of what's going on in the marketplace. Instead, what I think is happening is, number one, investment advisors may not realize that they too are vulnerable to biases. A great example. Over the last 5 years, prior to what we saw in the beginning of this year, we saw the Mag 7 and growth stocks absolutely dominate. So if you're an investment advisor and you notice that everything in your portfolios was starting to lean more towards this growth-oriented cap weight, that's an example of this. I tell a story of an investor, Prudence, and an advisor, Cornelius. So they have bad names, right? But I tell this adventure during the financial crisis, and through that visualization, because they make perfectly wrong decisions, even though they're both really smart and educated. But what I hope to express is that no, it's actually the investor that is making decisions. And what tends to happen is the investment advisor is sort of forced to come along with about a 6-month delay, as if the investment didn't have an advisor at all. It's not enough for the advisor to know or be educated. The advisor actually needs to create a communications construct that is explicitly, not vaguely, explicitly communicated to investors. And only then do you have any kind of real hope of, number one, not being vulnerable to some of these biases that are corrosive to returns. But here's a possibility. What if through this educational effort for both you and your investor, you're actually making counterintuitive choices? So you could not only match markets, but dare I say it, do better than the markets by coming in at times when most investors have the hardest time doing that.
So I'm going to be telling you a personal story because the book really resonated with me when I was reading through certain sections. So I'll be getting to that to illustrate that point with my personal experience in a few moments. But let's continue on and press forward in setting the stage before we get there. One of the things that you point out is the interplay between risk tolerance and risk capacity and how it's difficult to reliably quantify those two things, especially since so many people are unaware of what I think might be called capital market history. You give countless examples of, yeah, this happened. It happened in the 1800s. You may not have been aware of it, but we absolutely had a long recession. And we'll talk about, maybe historical things with regard to what happened to the Nikkei, the 225. And a lot of people, even though it's happened in real time, and it's been a third of a century before the Nikkei got back to its highs of 1989 year end, a lot of people think that somehow that it couldn't happen in North America. But in fact, it's happened at the time. Japan was the second largest economy in the world. So I wonder if you can give me an example or two of what you just said a moment ago. What could go wrong? And that's not necessarily saying things will go wrong, but the blind spots that people have because they're unaware of the history and what that might mean for their investing decisions and being more rational as they make them.
So I created a new word that I happen to like very much. And, William Shakespeare created 1,500 words. I figured I could give one or two. But what the corona bias refers to is a lot of what you're talking about there. It talked about the fact that, we had Spanish flu in 1915 starting. 25 to 50 million people across the globe died. I'm like, were they not keeping good records then? That's a big range. Anyway, almost 100 years later, we have another global pandemic that comes along. We're completely unprepared. We can't even imagine it. We can't think about it. And we just don't have immunity to those viruses, right? And in a similar vein, what I talk about and what corona bias refers to is the fact that things happen that were outside of our professional careers as advisors. And as a result, we prepare for inside of this sphere of like our experience, and outside of that sphere are things that have happened historically that we don't prepare for. But if they would happen again, it could be perilous to advisors. The two examples that I cite in the book, one is the Great Depression, where the stock market just absolutely demolished, 86% losses over almost 3 years, 5-year rally, and then another 5-year bear market. I do a visualization of a balanced portfolio with advisor fees, rebalances, all the stuff that you'd normally see. It is categorically unnavigable by investment advisors and their clients. The other example I refer to is the bond bear market between 1945 and 1981. 36-year bond bear market where bonds lose 21% real. And so if you're just a fixed income investor, and that's before advisor fees, right? That's just the index number. So it'd be down 50% with advisor fees over 36 years. And so then this is another, I think, key insight in the book, which is that it says, as an investment advisor, if you ask investors, they probably would say that they want you to help them be aware of these examples of times that they need to prepare for, because they're already ignoring history. They don't need you to do that. They view you probably as their chief risk officer. And as a part of that job, expand that circle, incorporate those things, which does not mean we're just going and hiding away, but rather think of it more in terms of an insurance policy. Like investment portfolio is one of the biggest assets these people have. Invest optimistically, but address contingencies of significant loss.
Well, one of the things that you may or may not know about me is that I wrote a book called Bullshit. And the subtitle is How Optimism Bias Threatens Your Finances. And a lot of what caused me to write that book, and I've written a couple others as well, is exactly what you're talking about, how a lot of people are not addressing contingencies and they're blithely going about their business thinking that, this has never happened to me before, therefore this never could happen to me, as if the past is prologue, and it most certainly isn't. And there's recency bias going in, and there's other behavioral things going on that a lot of people are loath to address and even contemplate in many instances. So let's go now into what you talk about in the book. One of the examples you give is, say, the challenges associated with a very traditional 60-40 portfolio. So the standard portfolio that's recommended for people is 60% in stocks, 40% in bonds. And that has been put forward and held out for generations by the industry as being the standard for which a balanced portfolio might be judged. And as long as you can stay invested in a long-term 60-40 portfolio, you should do fine on a balance of probabilities if you take a long-term view and don't do anything stupid along the way. What would you say are the primary challenges associated with a traditional 60/40 portfolio?
Well, as a starting place, I refer to the balanced portfolio as an historical accident. And it's fascinating. Bonds were created to finance government debts initially, later to finance companies. Stocks were created as a way to share ownership. And at some point, someone came along and said, let's combine these two things together. And how would that work? What's interesting is that's sort of where that idea that you're talking about began and ends. And despite the fact that we have many ways of accessing these different core asset classes, that's sort of where we are. But what never happened? What never happened is someone came along and said, okay, let's think about this more from a perspective of product design. What do investors want? And what does they require in terms of their economic and psychological needs? And then let's try to build it from there. And, one of the reasons that didn't happen historically is we didn't have all these different financial tools like options contracts to prevent against losses, or futures contracts or other things. And what's interesting is now with all of the evolution of product development, we now have the capacity to build in things that actually have true negative diversification. But going back to the balanced portfolio, sometimes bonds are stabilizers against stock market losses. Other times they're not. And you can find 5 examples in history that I talk about in the book where they either equal losses or add to it. What that reveals is that bonds aren't necessarily a reliable diversifier. I'm just going to go ahead and bring us right to this moment where, in the last 4 weeks, we just saw an example of a time when risk assets were selling off. Safe havens, instead of bolstering returns, we saw the yield on the 10-year creep up. We happen to be at a moment in time where got record sovereign debt in most developed countries across the globe. And that creates the possibility, a higher probability of financial crisis or bond market lack of stability. So we just happen to be living in this moment where there are threats to this question that is ubiquitously embraced by the financial advisory community, that bonds are a reliable stabilizer, right? So the question is, are there better ways to diversify than just this basic 60/40 construct?
So that brings me to the story that I wanted to tell. My experience, I've been a financial advisor for over 30 years. And about halfway through my career, we had the so-called global financial crisis from 2007 to 2009. And at the time, I was writing investment policy statements, but I was not a portfolio manager. So an investment policy statement, for those people listening, is a blueprint. It's a codified written, this is what we're going to have for our risk profile, and this is the amount of stocks, and this is the amount of bonds. And many of my clients indeed had a 60/40 portfolio, 60% in stocks, 40% in bonds. We're diversified by geography and by credit quality and, style of value growth, what have you. But a lot of my clients had a 60/40 portfolio, and they agreed to it in writing. I actually have their signature saying this is the target that we're going to have. And the investment policy statement, the blueprint, said we're going to rebalance the portfolio when markets get jittery so as to maintain a 60/40 mix. So in the crisis, especially at the end of 2008, markets were way down, stocks were way down. So that if you had $1 million in a 60/40 portfolio, your stock portion might be down by half. So now if you have $1 million, of which 600,000 is stocks and 400 is in bonds, now you've got 300 in stocks and 400,000 in bonds. And you should be selling a whole bunch of bonds in order to buy some stocks to get back to 60/40. And I had my clients' signatures in writing. And guess what? Clients didn't want to do it. And I didn't have discretion because I wasn't a portfolio manager. So here I am saying, I understand this. Of everything you talk about in the book, Philip, I lived it. I wanted my clients to rebalance. I was telling them, okay, well, we've got this. It's in writing. We're going to rebalance our portfolio back to 60/40, right? And the very large majority refused to rebalance. They didn't sell, they didn't panic, but they didn't rebalance either. They just kept it as it was. I had a couple clients who actually rewrote their IPS to make it more conservative so they could at least justify not rebalancing. But very few people were actually willing to rebalance. And so what I ended up doing is I said, so my hack was, okay, I'm going to fix this. I'm going to become a portfolio manager so that in the future I have discretion. I'm a fiduciary so that I can do what I always said I wanted to do, what my clients told me they wanted to do, but that they nonetheless did not do because they were behaviorally impaired. They just couldn't bring themselves to buy low, even though they absolutely positively told me in writing that that's what they were committing to doing.
Wow, that's amazing. Thank you for sharing that.
I'm reading your book and I'm going, this is a guy who is basically telling me what my life story is, because this is exactly what I experienced personally. So what you're saying is not purely theoretical. I'm a living, breathing case study of exactly what you talk about, how there's the intention there. The advisor is, I was doing so-called lifeboat drills where I would show clients an illustration of this is what would happen if the portfolio went down by this much. This is what has happened historically. I think we used the stagflation drawdown of 73, 74 as the example. This is what has happened. This is what could happen. It could be better. It could be worse. It'll always be at least somewhat different. But I want you to pre-commit to what you would do if this were to happen so that we can all agree on how to proceed going forward. So we've got a written game plan. And I got the commitment and the clients didn't follow through and I couldn't make them. I could only tell them and remind them and try to hold them accountable for their own commitments, but I couldn't make them do it.
Yeah. Do you think that in the example of your clients do you think that even though they signed the investment policy statement that they were really plugged in and like dialed into the idea that they would rebalance prior to that? Or was it really just a signing off without like fully committing and understanding?
So what I would say is now that clients have given me fiduciary responsibility for the past 15 years, because I became a portfolio manager immediately after the global financial crisis, because I was determined not to let that happen again.
Right.
Now they understand, okay, John, it's on you. We're going to give you that.
Interesting.
But before that, it was on us and we agreed, and there was it takes two to tango, and no amount of my saying this is what we had pre-agreed to was going to get them to change what they were going to do. So it was just an observation, that I had that everything you're saying in the book is exactly as you say. Okay, so that then brings me to my next question, which is what would you recommend to help people to respond to their behavioral biases with regard to portfolio construction, and then also on boots in the ground, how to rebalance, when to rebalance, why, pre-commitment, all those things?
Yeah. So I'll start with the portfolio, and the book titled The Behavioral Portfolio. Within it, I propose a new framework that does what I was talking about earlier, which starts and says, well, what do investors want? If we're going to start from scratch and build a product, they want, number one, not to lose their money. That tends to be the first objective. And number two, they want to have it grow, ideally above inflation. If they have gains, they want to protect the gains. They'd probably want to have as much consistency of growth as possible. And so I lay out those objectives. And then I say, well, how do you build a portfolio that attempts to do that in the best way possible? And what's probably be a relief to a lot of advisors is that if you start with a 60-40 construct, I recommend that you stick with that basic risk profile, that you make two critical changes. The first change is for your stock portion of your 60, put at least half of it or about half of it into a category called hedged equities. That's not hedge funds. It's a type of fund or ETF that you can put your money in that tries to be in the market, but then tries to use options or other ways to try to limit losses. And if that portion of the stock portfolio is effective, then that can meaningfully reduce things like losses in the Great Depression with the financial crisis. The other part, the half of your stocks is just fully invested. And then your fixed income needs to be in an adaptive model that can try to avoid losses from interest rate or inflation adverse effects. So as a starting place, then your portfolio itself is designed to address inflation, deflation, or stagflation. Then the second part of that, then the coaching around it, we have a very highly outlined construct that includes, in addition to the policy statement, we have something called an investment owner's manual. Talks about each of the 6 biggest behavioral challenges that investors face. And it creates a framework where now you tell investors, this is what's in the portfolio to address that. Specifically, here's the plan of action we're going to take when you talk about rebalancing. But there is an additional little step that I talk about in the book, which is a default rebalance. And where possible, if you just have a default, like if the portfolio loses this much or this asset class loses this much, we automatically do a rebalance in the portfolio. So not only does it not require an advisor to come in and make a decision or an investor, it's an agreement in advance to just automatically default and make that change. And then you don't have to worry about advisor biases coming along as well. Each piece, both the communication in advance, which is essential, the talking explicitly about how the portfolio is designed to address it, talking about what the course of action is, and then a default change once these problems play out. And I feel like, John, we've got to tackle, but it's so interesting that you share this story because for the longest time, it was such an iterative process to learn all these parts, like first building the portfolios, then building the behavioral guidance. And I refer to it as a 30-year learning curve that was always steep. Never got flattened out. And I'm going to go back to the very first question you asked, is why to write the book. Is that I started having conversations with advisors after they read the book. And it was so awesome because I feel like I couldn't have enough meetings with an advisor to help them really get everything. So it's the kind of thing that requires a long form narrative. It's the perfect reason to write a book. And there's another advisor, $1 billion advisor I just talked with on Friday. He said, like, I read your book and this is the handbook. And it's like, I want to save everyone that 30-year learning curve. That's the idea.
Well, it's funny. And again, because I've written 3 books of my own, and that's exactly my rationale too, is I'm trying to tell people this and this, but it's always dribs and drabs. And I'm constantly getting, yeah, but. So I said, okay, damn it. I'm just going to sit down and write it all soup to nuts from beginning to end. Here it is. And we can discuss the merits or lack thereof, but here are my footnotes. Here's my research. Here's what the evidence shows. What do you got? And a lot of people find ways to resist things because they're comfortable doing things the way they've always done things. And they resist the fact that there's evidence that shows that there are oftentimes better ways, or at least maybe blind spots that they might not be thinking of. So what advice would you give to advisors who want to have a unique value proposition of actually helping people make better behavioral decisions, make better wealth decisions for a situation where emotions are very, very likely to get in the way?
Thank you for that, because really, if you get value from something and you want to realize a benefit from it, you really need a call to action. And so I would say, read the book and also read Bull Shift. In the book, there are exact prescriptions for what to do. Our firm has additional collateral to support executing through that, which includes the investment owner's manual, which I talk about in the book, which we have. That we have things that are white label prepared where you can, as a firm, bring them in. It supports the sort of basic ideas we're talking about in the book. Brand yourself as being a behavioral coach. And really, I think it could transform your business, and it can help you create an identity and a framework for investing that may be a differentiator from other people in the industry.
It's interesting because, fun fact, both you and I got Daniel Crosby to do a testimonial for our book. So it's kind of funny how, Daniel's one of the gurus of behavioral investing in Canada and the US. And so it's just fun that you and I have finally connected with one another, because it's as though we were destined to meet at some point. And I'm like you. I'm a big believer in making things actionable and having calls to action and trying to get people to not just understand, but to actually change their behavior in order to get better outcomes. Are you optimistic that we're making progress, that the ideas in your book and that the progress that's being made, generally speaking, in terms of portfolio management, are doing enough to incorporate behavioral biases and maybe figure out hacks to overcome the blind spots that we all seem to be prone toward?
Honestly, John, I'm a bit crazed right now because of what I feel are some of the... Ray Dalio is obviously very skeptical about issues around global debt, sovereign debt. And I've, for many years, talked about even 7 years ago, I had challenges around the potential global debt crises that I was presenting. So globally, I'm not really that optimistic in terms of for enough people to change to make a difference. And sort of my mission now goes way beyond just selling the book or raising money for our assets. It's sort of I feel like this is the most consequential moment in my career, where if there's some risks that are out there that are big enough and bad enough, that we need to really feel like one thing I do want to do more than anything right now is just share those risks, talk about to the advisory community, investors, about how to think about them and how to address them in ways that, it doesn't mean that we're going to see these things realized. But if the probability of some of these risks becomes great enough, I think it's time to address it. There is absolutely a reason now to consider alternatives to the Jack Bogle 60-40 approach and be more inventive around this. And, for example, my business, maybe your business too, I am personally not fearful about our business. I feel like our business will do very well regardless of what happens. So it's really about bringing as many people in as possible to these ideas that we're already talking about.
All right. So we've got to wrap up here. We're running out of time. And this has been fascinating. I'm sure that I could talk to you for hours and we could sort of share war stories and commiserate about what we can do to fix all the world's problems, but we're running short on time. So the podcast is called Make Better Wealth Decisions. And I'm wondering, Philip, if you could offer some advice, if it was up to you, if you could offer 1 or 2 kernels of wisdom, what advice would you give to listeners to help them make better wealth decisions?
Talk to your advisors and ask about, is there a way to incorporate a hedged equity approach for a significant part of my equities? And I say that at this moment because we've had some volatility in the markets this year, but we're not that far down at this moment globally. So I think it is not too late, but there can be a moment where it is, or you're going to feel like it is. And it's much harder to make a change when you've already lost money. And the other change is I would, at the moment, eschew core bonds and think about adaptive approaches in portfolios. See if there's a way you can change that to preemptively, again, address the possibility of some kind of a trust-like, whether it be over a short-term or long-term credit dislocation.
All right. So once again, for the people at home, my guest this week has been Philip Toews. He is the author of The Behavioral Portfolio, Managing Portfolios and Investor Behavior in a Complex Economy, which is available right now everywhere you get books through Harriman House. Philip, it's been a pleasure. I really enjoyed your book. I want to stay in touch, and I want to wish you all the best in the future because you're doing important work in helping people to truly make better wealth decisions, and it will be consequential. So thank you for sharing your time today.
Awesome being here, John.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.